Well, this is Richard C. Wilson at the Family Office Club, and today we're doing a member spotlight interview with Daniel Hughes from Hughes and Company. Welcome, Daniel.
Hey, Richard, how are you? Thank you
Good,
for
how about
having me.
yourself? Sure, no problem. Glad to have you here, and it was good to see you at the Super Summit a few months ago, and I know we bumped into each other at another event in Q1 before those were shut down. I want to talk a little bit about your firm, Hughes and Company. You've been part of the Family Office Club for a little while now. What is it that you guys do exactly?
So we're an introducing broker that focuses on the futures landscape. Primarily, that is serving as the home base for commodities trading advisors. In the management of their customer accounts, kind of their go-to to make sure their business flows smoothly. Also, we introduce full-service brokerage for family offices and companies who trade on their own or who also allocate to commodities trading advisors as part of their overall portfolio. And then because of that and our expertise and spending a lot of time in that field dedicated to it, we've also started introducing commodities trading advisors to qualified investors who express interest in the space and want to know more about it and kind of have just more options on the table as part of their diversification process.
Sure. Okay. And a lot of investors have money into the stock market, ETFs. Maybe they start with single family rentals, and they might allocate to some independent sponsors from the real estate space. What types of investors do you see allocating to CTAs? When should people be considering that, and how do they act differently than other things that are typically in people's portfolios?
Okay. So a lot of that comes from my background as well. I started out at Deutsche Bank in New York City, and I did institutional sales there. And I worked with RIAs and family offices, and they primarily managed, kind of plain vanilla, equities, long, short. And what I did at Deutsche Bank kind of culminated my career in investment management as my role as a broker. So what started out as providing research to investment advisors and working with them, I've kind of developed a good track record of having involvement with investment advisors. And how that's developed, from Deutsche Bank in New York City, I moved down to South Florida, and when my wife wanted to get her PhD, and I worked at TradeStation on the institutional desk there, involved with a lot of different asset classes. So not only futures, but involved with equities and pretty much the whole landscape of investment opportunities that are out there. Branching off to setting up Hughes and Company, I focused specifically on futures as it was an avenue where I got a lot of interest for advisors that were, especially emerging advisors. And it is an asset class that is very complementary to an overall portfolio. So with what we mainly do now, I see a lot of interest in the futures landscape, not only from family offices and from investors in general, but as well as advisors and firms that want to hedge risk or have the futures component as part of their overall portfolio.
Sure. And I didn't know that you were at TradeStation. Lance and Willie are old friends of mine who were there for several years, maybe around the same time as you. In terms of how futures and CTA managers have done during all the volatility going on right now, I'm sure there's a full spectrum of ones that have done well, ones that have not done well. But I know in some types of hedge fund strategies, for example, the whole strategy is to capture volatility and be in and out of trades, and sometimes they excel when there's a lot of volatility. How do CTA funds, typically adapt during a time like this, or a lot of them built for a time like this, or how's that looking across the clients that you're serving?
So, as you said, there's a good dispersion of returns across CTAs. A lot of CTAs may focus on specific sectors, or they might focus on particular strategies, be they short-term or be they long-term, in terms of how they approach the overall investing landscape. I guess to take a step back, if you look at the primary role of kind of the CTA itself, a lot of investors that come into the CTA landscape, they might want to get exposure to a particular asset class, and that's something we can touch on in a second. But in terms of the the investment returns, typically what you're seeing is a lot of non-correlation. What happened during the sell-off and obviously in February and March, you saw a lot of positive correlation with the S&P. So there were periods of times where the market sold off, but then a lot of other products sold off alongside it. Just because at the end of the day, anytime you have a significant event, there's going to be liquidation, type events that kind of correspond with that. So then you saw, gold come down at the same time you had a massive market, kind of meltdown there. And, the primary goal of what you're kind of bringing on with the CTA is kind of getting a little bit of non-correlation or even negative correlation to that. So that way, if there's an event where kind of everything across the board is being sold off, you have a component of your portfolio that will not kind of go along with that move. And we saw a lot of that with the overall CTA industry itself, as it's kind of geared for that. And there's and a lot of the inherent characteristics in futures makes it kind of more efficient to come about it in the futures landscape.
Okay. And I'm sure there's some people listening who have heard of hedge funds. Some of them have heard of CTA funds. I know there's some hedge funds that might use options and futures. Are some CTA funds also referred to as hedge funds? And can you define kind of the difference between those terms for people listening?
Yeah, so basically your CTA is your commodities trading advisor, and they're going to be limited primarily to trading futures contracts. Now, they do this primarily in two ways. So they can work with you as a separately managed account, or they can have their commodity pool, at which point they'll be also a commodity pool operator. And then you're basically joining into a fund, which has its own advantages in terms of taxation. So basically they operate in primarily two methods. And the benefits of the futures industry basically in general is that you have certain efficiencies over kind of the equities products. On a basic level, a lot of the commodities started getting exposure to RIAs and high net worth investors, through the use of ETFs. And what people might not fully understand, and we especially saw this in the crude oil sell-off, is that these ETFs are based in the futures markets, as an overall underlying product. So some ETFs may have a physical underlying holding, but a lot of your ETFs that are going to be your crude oil ETF or some of your grains ETFs, they're actually, without you going through the prospectus, a lot of people really aren't sure how they're actually achieving those returns. So if you take a step back, futures is going to be something that you want to have direct access to kind of be more efficient, because ETFs are basically investing in the futures market. And unless you go through the prospectus, you might not be 100% sure, are they buying just the front month contract? Are we in a contango situation where there could be a negative basis from rolling that contract, as we saw with crude oil? So a lot of what investors are starting to see in the futures world is that they can actually come and trade directly in the futures market and be a little bit more efficient and kind of avoid certain kind of herd characteristics that might be there with ETFs. So they have more flexibility with where along the futures curve that they might invest, as well as the decreased margin requirements.
Right, right. Perfect example is the USO fund that had money pouring in from retail investors while they had big losses, right? But investors just kept on piling in because they didn't understand the futures contracts that the USO ETF, was basically based on, and they weren't buying a spot price on oil. It wasn't really what they probably thought they were getting. And a lot of investors, lost money on coming into that because of that disconnect that you're just talking about, I think.
Right. I think that, ETFs definitely serve their purpose. They have a positive nature to them, but there are inner workings, like you said. And when there are, especially issues that we saw with crude oil, in essence, we had a situation where, delivery was upcoming. There was only a couple days left in the expiration date of that contract. And what happens is, you had a liquidation type event where you had people that had to close out their contracts before they were going to be, physically held to deliver or receive those products. And what happens is, when you trade in the futures market, you get to pick based on each product has its own months that are associated with delivery. And at a certain point, when you approach that date, the product can become more volatile, and typically you would want to roll out to the next month. When you're investing in ETFs, basically you're participating in whatever that ETF does. And when an ETF hits a certain size, that ETF alone can cause significant market disruptions, whether it was related to a domestic ETF or an offshore ETF, as I saw on the news.
Right.
In essence, by trading in the futures markets directly, you can actually tailor your strategy to where you want to be, given what you think will happen in what time frame. There's a level of seasonality. There's a level of consumption with every product, and that's something that you can utilize.
Right. Okay. What's the number one due diligence question that a CTA fund should ask, a group like yours, and trying to figure out who's the best firm to get their service through and to get their brokerage through? And what's that? Maybe nobody asks you the question, but what is the question that they should be asking you think, in the space to make sure they make a wise decision?
Well, in terms of an allocation to an advisor or just participating in the futures industry, I guess the first and foremost is that with every product, there's a certain level of diversification that you have to have. So investors should definitely avoid concentration into any particular asset class, any particular instrument, any positive correlation should always be examined to make sure that you're fully, kind of diversified across the spectrum. Because at the end of the day, nobody ever really knows what's going to happen. All you can sort of do is kind of best position yourself for what could happen.
Right.
I think on the due diligence perspective, on the ETF side, everyone should always have a full understanding of anything that they invest in, and also the risks that are inherent in that, be it an ETN or an ETF, even the basic level between just that. When you start looking at CTAs that you want to invest in, not only do you look at their tear sheets, that a tear sheet is something that they might provide to say, this is how I've done, this is sort of some basic statistics on my program. You always want to go through and do the proper due diligence there as well. So you want to kind of go through their disclosure document, get a good understanding of what they do, what their risk profile looks like. Typically, you can always look for more detailed figures on their returns, especially if they're a short-term program. You can kind of see the daily volatility because
Right.
A monthly tear sheet kind of just takes a snapshot at the last day of the month, but intra-month, there's a lot of information that's kind of missing. So, what I would recommend for anybody that with any investment advisor, to get a good idea of how they manage your money is to get more of an in-depth kind of review of so you have an expectation, because volatility of an advisor is not necessarily a bad thing. It's just something that you should be aware of going into any investment.
Right.
There's obviously going to be some return expectation that goes alongside any increased volatility. So that's something that is very important for people to look at.
Right. Okay. Makes sense. Great. Well, I think this is an area that we haven't focused a lot on at the Family Office Club, and I think a lot of family offices need more sophistication in this area and need to learn about it. So happy to have you as part of the Family Office Club. What's the best way for someone to get in touch with you and have a phone call or get some materials on how to work together with you?
The best way to reach out to me is either going to be through you or even just calling us directly to just have a conversation. Our direct number is 954-500-0500. And obviously anybody on Family Office Club can reach out to you and reach out to me.
Sure.
We obviously have a website, but it's pretty basic. In terms of most of what we do, is everything is so unique depending on every investor's and family office's situation. A lot of the times, family offices, they might not require CTAs, but they might say, you know what, I need a more efficient kind of a way to protect my overall portfolio. How can I do that on the future side? How can I get exposure to crude oil, but I don't necessarily, should I buy the ETF or can I trade in the futures markets? We get a lot of questions like that. And a lot
Sure.
of what we do is we kind of serve as a partner in their business to make sure that they have the most efficient way to kind of build that infrastructure out.
Right.
And it's gone pretty well. So
Cool.
So yeah, people are welcome anytime, and you know, my viewpoint on everything is if I can provide information that's helpful to people, then you know that makes me happy.
Great. Awesome. Yeah. Well, I appreciate you being part of this here, and perhaps maybe on a webinar down the road or a discussion panel, we can have you share more on futures and CTA funds, et cetera. I'll be happy to connect anyone who would like to get in touch with Daniel. And thanks again for your time today.
Thanks, Richard. Have a wonderful day, and hopefully this all blows over relatively soon. I look forward to many of the events that you have. They're always a great time, and I can't wait till we do it again.
Yeah, me too. Thank you. Take care.
All right. Thank you. Bye-bye.